What's up, everyone? Welcome back to the channel where we share with you everything about personal finance, investing, and entrepreneurship. Today we are diving into one of the best-selling books of all time, The Intelligent Investor by Benjamin Graham. This book was first published in 1949 and has since then sold over 7 million copies. It is considered to be the Bible of value investing, and it contains timeless principles that can help any investor navigate through market ups and downs. So if you have been thinking about investing, but do you want to know where to start, or want to brush up on your investment knowledge, this video is for you. In this video, we will cover some of the most important lessons from this amazing book, so you can see why it's worth reading, and what kind of impact it can have on your investing journey. Before we dive in, make sure to hit the like button and subscribe so you don't miss out on future videos. And without further ado, let's get started. Chapter 1. The Little Book That Could. Benjamin Graham was a professor at Columbia Business School and is considered to be one of the founding fathers of the security analysis. He was also the mentor of Warren Buffett, who credits much of his success to the teachings of Graham. The Intelligent Investor is Graham's magnum opus, a culmination of his years of experience in analyzing securities and teaching others how to do the same. In the introduction to the book, Graham explains that while the stock market can be very profitable, most investors cannot beat the market because they allow their emotions to take control of their decisions. Instead, Graham advocates for a more disciplined approach to investing based on fundamental analysis and sound reasoning. He suggests that by following the principles outlined in the book, even an intelligent investor who has little knowledge about the stock market can make good investment. One of the key strengths of this book is its writing style. Despite being a dense and technical subject, Graham manages to make the material engaging and accessible to a wide audience. He uses simple language and real-life examples to explain complex concepts, which makes the book a pleasure to read. Another strength of the book is its focus on practicality. Graham doesn't just provide theoretical concepts, but also offers practical advice on how to apply them in the real world. For example, he gives specific guidance on how to analyze a company's financial statements and what to look for when making an investment. This makes the book a valuable resource for new investors who want to start investing right away. Despite being written in 1949, The Intelligent Investor remains relevant today. The principles of value investing that Graham outlines in the book are timeless and can be applied to any market conditions. In fact, the book's enduring popularity is a testament to its relevance. It has consistently been one of the best-selling books on investing, and has been praised by investors and experts alike. If you're looking to invest in the stock market, I highly recommend The Intelligent Investor. Whether you're a beginner or an experienced investor, there is something in this book for everyone. With its clear writing, practical advice, and timeless principles, The Intelligent Investor is a must-read for anyone who wants to succeed in the stock market. Chapter 2. Defensive and Enterprising Investors. Benjamin Graham categorizes investors into two types: defensive and enterprising. A defensive investor is someone who invests primarily to preserve capital and generate income rather than maximizing returns. They tend to be risk-averse and prefer to invest in low-risk stable investments such as bonds and blue-chip stocks. On the other hand, an enterprising investor is someone who is willing to take on more risk in pursuit of higher returns. They enjoy the challenge of investing and are comfortable with market volatility, as long as it means greater potential profits. It is important to note that these are not mutually exclusive categories, and many investors fall somewhere in between. Most people are neither purely defensive nor purely enterprising, but rather a combination of both. Graham argues that the type of investor you are depends on your individual circumstances and personality. There is no right or wrong type of investor, and what matters most is that you choose the approach that aligns with your goals and comfort level. For defensive investors, Graham recommends a portfolio consisting of a majority of high-quality bonds and a smaller percentage of common stocks. He suggests diversifying across different industries and avoiding investments that are too volatile or speculative. On the other hand, enterprising investors can allocate a larger portion of their portfolio to stocks, including more risky growth stocks and small-cap companies. However, Graham still emphasizes the importance of diversification and advises against investing in a single company or industry. Ultimately, the goal is to find the right balance between risk and return based on your individual needs and preferences. Chapter 3. Mr. Market. Mr. Market is a fictional character created by Benjamin Graham to represent the psychology of the stock market. In Chapter 7 of The Intelligent Investor, Graham uses Mr. Market as an illustration to explain how investor emotions drive market fluctuations and how these fluctuations can create opportunities for rational investors. Mr. Market is depicted as a manic depressive who offers to sell investors his house every day for a different price. Some days he is exuberant and sets an outrageously high asking price, while other days he is depressed and offers the house at a rock-bottom price. However, the actual value of the house remains constant. The key to making money with Mr. Market, according to Graham, is to ignore his emotional swings and make decisions based on the intrinsic value of the investment. When Mr. Market is euphoric and offering to sell you his house for a high price, it's a sign to stay away. Similarly, when he's depressed and offering the same house for a low price, it's an opportunity to buy. This concept is a powerful metaphor for understanding the stock market. In reality, the prices of publicly traded companies fluctuate constantly due to factors such as investor sentiment, news events, and economic data. However, the underlying value of a company's stock is determined by its fundamentals, such as earnings, cash flows, and future prospects. By understanding this, investors can avoid the trap of making emotional decisions based on market volatility, and instead focus on making rational decisions based on a company's intrinsic value. Just like Mr. Market's house, the price of a stock may fluctuate daily, but its underlying value remains constant. By recognizing this, investors can position themselves to take advantage of market inefficiencies and make profitable investments. Chapter 4. Margin of Safety. The margin of safety is a concept in investing that refers to the difference between the price you pay for an investment and its true value. Benjamin Graham introduced this idea in his book, The Intelligent Investor, as a way to protect against the unpredictability of the market and reduce the risk of investment losses. To understand the concept of margin of safety, let's imagine you're buying a share of stock. The price you pay for that share is determined by the current market conditions, investor sentiment, and other external factors. However, the true value of that share is determined by the company's underlying fundamentals such as its earnings, cash flows, and future prospects. When the price you pay for an investment is significantly lower than its true value, you have a margin of safety. This means that even if the market price drops below what you paid for the investment, you are still protected, because you have a cushion between your purchase price and the true value of the investment. To illustrate this, consider the following example. Let's say you buy a share of stock for $100. According to your analysis, you believe that the stock's true value is $150. In this case, you have a margin of safety of $50. If the market price drops to $120, you would still feel comfortable holding on to the stock because you believe that it is still worth $150. However, if the market price drops to $80, you might start to panic and consider selling the stock because you would be taking a loss of $20. But because you had a margin of safety of $50, you don't need to sell the stock to cut your losses. You can wait for the market to recover, and eventually the stock price should return to its true value of $150. In general, the wider the margin of safety, the less risky the investment. Conversely, the narrower the margin of safety, the more risky the investment. By focusing on investments with a wide margin of safety, investors can reduce their risk of losses and increase their chances of making profitable investments. This is one of the key principles of value investing, and it's an essential concept for anyone looking to invest in the stock market. Chapter 5. Diversification. Diversification is an investment strategy that involves spreading your money across different assets, industries, and geographical regions to reduce risk and increase the potential for returns. The idea behind diversification is that if one part of your portfolio performs poorly, another part may perform well, and vice versa. This can help to mitigate losses and provide a more stable investment portfolio. Benjamin Graham, the author of The Intelligent Investor, advocated for diversification as a key principle of investing. He believed that diversification was especially important for defensive investors, which is a term he used to describe investors who prioritize capital preservation and income generation over high returns. Graham recommended that defensive investors allocate a majority of their portfolio to high-quality bonds and a smaller percentage to common stocks. This approach allows investors to take advantage of the potential growth and higher returns offered by stocks, while mitigating risk through the stability of bonds. However, diversification should not be taken to an extreme. Graham cautioned against investing in a single company or industry, but he also warned against over-diversification. He believed that investing in too many different assets can actually reduce returns and increase transaction costs without providing a significant increase in diversification benefits. Overall, diversification is an important concept for investors to understand. It can help to reduce risk and provide a more stable investment portfolio. However, it's important not to over-diversify, as this can actually reduce returns and increase costs. By understanding the benefits and drawbacks of diversification, investors can develop a well-balanced investment strategy that meets their individual needs and goals. That's it for today's video. We hope you enjoyed our summary of Benjamin Graham's The Intelligent Investor. If you found the video helpful, please give us a thumbs up and leave a comment below. Don't forget to subscribe to get notified when we release new videos. Thank you for watching, and we'll see you in the next one.